The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Oh, there's the music. Hey, good morning, everyone. It's Money in the Morning with Mitch Goldberg. The sun is starting to come out. We had a little snow cover on Long Island, just a little bit, but I applaud my fellow Long Islanders. Yesterday was rainy, no traffic where I went anyway around Long Island. Today, a little AC conditions, no traffic. Guys, we are doing good on the roads. Very proud of you all. All right, so let's get this day started. The Dow futures down 180 points. Yesterday, the Dow was up over 350. That was a little pullback, no big deal. Just because the futures are down, it doesn't mean that's how the day ends. This is just a snapshot at the moment. Kind of like if the market was open now, let's say it was 2 p.m, and I could say the Dow is up 200 points. You know it's just a snapshot. So that's what we go over first. S&P futures down about 14. NASDAQ futures down about 19. Oil is flattish, 78.91. The 10-year yield. Yesterday we spoke, it was 3.49. Now it's 3.46. So long-term yields are coming down ever so slightly. So that's the thing. You think, oh, well, aren't interest rates going up because the Fed's raising rates? No, the Fed has more sway over short-term rates, like the federal funds rate that it is expected to raise today by 1/4 point. 10-year yields are really more of a market thing. It's investors decide if they want to own longer-term bonds or they want to sell longer-term bonds. That causes fluctuations in long-term interest rates. So just to let you know that not all interest rates are created equal. We went over that yesterday in pretty good depth, but that's just what I just said now. I think summarizes it pretty good. Private payroll figures were up only 106,000. It would have been more. Big weather fluctuations around the country in January held back hiring, and what otherwise has been a pretty strong labor market. In spite of the Fed raising rates, market's been pretty strong. Okay, so we continue to, see a stronger labor market than what those who are expecting a recession would anticipate. So today is also mortgage rates. Mortgage demand was down 9% from last month. Refinancings are down over 80% year over year. And that is in spite of mortgage rates being down a little bit. Now, the reports I'm reading didn't say anything about weather, but, I'd imagine the severe weather all around the country definitely impacted the mortgage rates. Forgive me, guys. I am getting over the most horrendous cold, and I've got this cough for about 2 weeks that is so persistent. It's persistent like inflation. Oh, that was not even, whatever. Let's just go on, okay? So mortgage demand was down a bit. Let's go on to the big news of the day. The Federal Reserve meets every 6 weeks to set interest rate policy and to either strengthen the economy, weaken the economy, tamp down inflation, or play around with, interest rates to just tamp down inflation by slowing the economy down. So today the Fed meets. We're expecting a 1/4 point move. This is so widely anticipated that it's basically it's a non-event, the actual rate increase. What is significant is the statement that comes out that will say that, and what the Fed says, the Federal Reserve. I always just call the Federal Reserve the Fed, just so you know. So we're going to see what the Fed does, and we're going to see what they say. And we want to know, does Chairman Powell, Jerome Powell, Chairman of the Federal Reserve, does he say we are going to keep raising rates? We are going to pause and see how the effects of our recent rate hikes have impacted the economy. Is he going to say, are we going to remain at this level for a long time because inflation remains persistent? I think that's what it is. The street is expecting Powell to say 1 or 2 more quarter-point rate hikes and to leave rates at that higher, short-term rates at that higher level. He's going to get to 4.5 to 4.75% for the federal funds rate. This is the 8th rate hike since the Fed started raising rates. And this is of the 8 hikes in the last, let's say, year or so, this is the fastest we've ever seen the Federal Reserve raise interest rates. So he's expected to leave rates where they are for a while, a little on the high side. So you'll be getting probably pretty soon, 4.5%. You already should be getting over 4% on a money market account. So if you have cash sitting around and you're leaving all your money in a checking account thinking that it's not even worth moving, you should think again, okay? So we talked about where to put cash, other short-term cash equivalents. I could address that again. I will momentarily. So that's what we're expecting. He's going to raise rates a little bit. He was raised them 0.75 point, then 0.5 point. Now it's 1/4 point. Next time will be 1/4 point. He may go for another 1/4 point. He may not. But he's expected to leave rates at these levels for some time until inflation comes down more persistently, stays at a lower level. Then we could go into a pivot where the Fed actually starts to talk about cutting rates. So those are some of the things that's really the big thing today. Other than that, we have a couple of big movers today. So let's take a look at what's moving markets, okay? Snap used to be called Snapchat. Now they just call the company Snap. Stock is down over 15% this morning. They missed analyst estimates. Internal forecast assumes a sales decline of between 2% and 10% from year earlier. That's having a knock-on effect on Meta. Meta used to be called Facebook. Okay, so Meta reports numbers after the close. We want to see what they have to say about daily and monthly average users, and we want to see what they have to say about advertising, and we really want to see what they have to say about the Apple's changes to their policies, which is basically impeded severely Facebook's ability to track you across the internet so that they could serve up ads that are more suited to you. Some call it ads more suited to you, and some people call it being too nosy and a violation of your privacy. So depends on where you fall on that. I think they both could work. If you're an investor in Meta, you want those targeted ads to come back. If you're a privacy advocate, you never want them to come back. So we're trying to find our way, and that's one of the reasons why Facebook Meta has been such a tough stock to hold. Advanced Micro Devices is up a little bit, beat earnings, beat revenues. Forecast isn't that great, but the stock had already been down so much that the stock is actually up a little bit this morning. Electronic Arts, video game publisher, down just about 10%, missed on everything. Not such a great forecast coming up. Company announced a delay of its upcoming Star Wars game. So, nothing to be overly excited about near term. Foot Locker adds about 3%, getting an upgrade from Credit Suisse. Match Group, Match.com, the online dating company, slid about 8% this morning, missed on revenues. I guess the business of love is a little tougher these days. I wonder if Match is down because people are starting to go out more now as opposed to being stuck in during the pandemic where online dating apps was like the only place you could really meet people. Western Digital dropping a little bit today, missing earnings, although it did beat on revenues. I don't mind, by the way, when a company misses on earnings. If they beat on revenues, I could get over the earnings mess because ultimately the revenues to me is harder to come by. Sometimes companies have to invest more in their business to get those revenues. Sometimes an order came in earlier or later than expected. So earnings are a moving target, but revenues, sales are, to me, the more important metric. Brinker International, That stock is up a little bit, decent numbers on the top and bottom. You'd expect that though, because all we hear about is people going out and how it's hard to find labor for restaurants and stuff, which by the way, for the private payroll jobs, up 106,000. The biggest industry was travel, leisure, and restaurants. So that's what's going on with the big picture. We're going to get into the small picture, the personal finance stuff, the stuff that you need to make decisions on, so we could put all this gobbledygook together and actually help you make a better financial decision going forward. I'm Mitch Goldberg. You're listening to Money in the Morning with Mitch Goldberg. You can also check me out for more information at clientfirststrategy.com. You're listening to 103.9 FM, LI News Radio. Okay, let's get rid of the music and let's get back to the show, the good information. All right, so just a little bit more about the market. So welcome to February 1st of 2023. Let's just take a quick overview of the month because, a lot of people feel that how the month of January goes for the stock market, as goes the year. And, those little rules of thumb are there just enough to throw you off and build some sort of case for some kind of confidence. I don't really put too much stock in those kinds of things. Or the first day of January, the first week of January, the first month of January. Oh, those are up, so it means the whole year is going to be up. Maybe not. If anything has taught us, especially in the last couple of years, anything can happen at any time, and it's out of our control. But people do grope for things to help make sense of the world, put things in order, and gain a sense of control. I get it. We all want a sense of control. But we can't control what the market does. And even though we have these nice statistics coming around, the market's up in January, so that's good for the year. First of all, the major averages, probably you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. But the major averages, NASDAQ, for example, was down something like, 9% in last December. But all the major averages were down. December was a tough month, but so far this year to date, which is the month of January, S&P is up 6%, NASDAQ is up 10.68%. But we're just kind of getting back to where we were, 7 weeks ago. But I do see pockets of leadership. So this is really important. I want to teach you something really important about investing. So every bull market, we have these leaders. And, the last bull market was marked by FANG, Facebook, Amazon, Netflix, Google, Microsoft. You could add NVIDIA in that mix. And, we could add a couple of others. But those were like the mega cap winners that kept lifting the markets to new heights. Even when the smaller pandemic stocks like the Rokus and the Pelotons were getting absolutely crushed, you couldn't tell by the S&P 500 or the NASDAQ because the big stocks are the ones that really move the market. The other ones, like a Peloton, if Peloton literally just disappeared as a stock, it would have no impact on the averages. It's not even, it would be completely imperceptible because it's so small. So anyway, what happens is when we go into a bear market, finally the leaders get hit. They go down a lot, like Meta, Facebook went down about by half last year. And then we get into a new group of leaders. And investors very commonly go to the last group of leaders and they keep averaging down, they keep buying more and they keep buying more. And some of those former leaders will regain their leadership status. Some won't. Some are just a bounce back in January. One of the things that marks the really good stock market performance so far this year is just that the stuff that got crushed the most last year, we're having a really good January effect. The tax loss selling is over and Now a little bit of buying comes into them, in some cases a lot. They go up, they drift higher. But now we're getting into the real work. And I see some new leaders emerging that are not technology. So you have to see what the stock market more or less chooses as its leaders. And when stocks do become leaders in the market, in a new bull market, they typically, their leadership is very persistent, very long lasting. So I'm going to give you two that I see are doing very well. Good news coming out and just persistently in good shape. One of them is Boeing. Now that stock a couple of years ago was about 400. They had the problems with the MAX jet, two horrible crashes. They basically stopped selling aircraft. Almost all of their orders stopped for like 2 years. Orders came back once the MAX jet was recertified around the world. FAA certified it, then the Europeans. I think China has recertified it. But the company's CEO was out yesterday, and the numbers from them were really good, the most recent numbers. And their order book is full. Business is booming for them. And that stock is up about, I think the stock, I just checked. I look at so many stocks, guys, so I'll just give you the better number. Year to date, it's up almost 12%. But that looks like a persistently strong leadership stock, and it's been like that for a couple of months now. It just seems to be very durable, and business is very good, and it's a large company, so it's large enough to actually start to have an impact on the major averages. It's a $127 billion market cap, although much smaller than the other mega tech stocks. It is big enough to have an impact and pull the industrial sector with it. Another one is PACCAR. Have you ever heard of PACCAR? They make Peterbilt and Kenworth trucks, and that stock is right off its high. And year to date, that stock is up 10.45%. Now, I have to say this. I don't want to come off like I'm making an outward recommendation. Some of you could say, oh, it sounds like, I'm just saying I see leadership emerging in industrial stocks. And the two industrial stocks, which I think are the best indicators of what's happening in the global economy and our economy, are Boeing, because it's a worldwide company. There's only two major manufacturers of commercial airlines. There's Airbus in Europe and Boeing in the United States. And that business is doing very well. So when Boeing goes up, it creates tons and tons of jobs, suppliers, and it's a global supply chain. The other one is PACCAR. So when you see PACCAR do well, trucks are selling, it means commerce is pretty good. Stuff is moving. And just so you know, everything you have has been on a truck at one time or another. All right, enough about the market. I want to talk about investing decisions because we've got a couple of minutes left. So here's what I want to say. True story. Sat down with a client yesterday, and we had a choice to move the client's son's 529 plan into cash or keep it invested gingerly, in a pretty conservative mix. And it was, the client wasn't sure if he was going to need the money over the next 6 months to a year or not. But so, and he looks back with a little bit of regret. Maybe I should have just kept it fully invested. And my point is no, because once you have a need to turn your investments into cash to pay for a financial obligation, because 529s are for college, you don't leave it invested. That's the point when, even getting up to that point, by the time you get to that point, it should be in cash. Turns out the client didn't need to use those funds for higher education for a couple of years. And there's a little regretfulness in his voice. Maybe I should have left it invested, but you don't know. So here's the thing. Do you let the market dictate of what you think is going to be good performance? Do you let the market dictate your decision? Or do you make your decisions based on personal finance? I find it's best to make your decisions based on your own personal financial decision and not try to time the market. I'm not saying there are people who cannot time the market, but by and large, most of us are employed or hopefully employed. We're busy. We're doing things. We don't have time to follow the market all day. And even if you could time the market on a short-term basis, all you have to do is be wrong once to destroy all the gains you've had in like the last 20 times you were right, okay? So my point is, don't look back, don't regret, plus the market went down a lot anyway, because you have to make it based on your personal financial decisions, your personal finance. That's how we make decisions. It's harder to do this with individual stocks. Now you're trying to sell stocks, buy them at the optimal time. But best to go with the optimal time for your financial situation. And this is why I think it's so hard for individual investors to own individual stocks. I'm not against it, and I certainly use individual stocks in my own investment management practice. But for most people, the timing of corporate news and when stocks go up just never coincides with your personal finance. You're listening to LI News Radio 103.9 FM. Oh my goodness, the time goes by so fast. You're listening to Money in the Morning with Mitch Goldberg. Thank you so much. I'll be back tomorrow morning. Have a great day.
Securities and investment advisory services are offered through Next Financial Group Incorporated, member FINRA SIPC. Client First Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and Client First Strategy and not those of Next Financial Group Incorporated. Views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial